I want you to picture two bank accounts. Same city, same income, same starting point. The first account belongs to someone who feels calm only when they see a large cash balance. Every extra dollar goes straight into savings. No investing, no risk, just numbers growing slowly in the bank. Over time, that balance reaches $70,000. Now look at the second account. This person keeps about $15,000 in cash, enough to handle emergencies, but everything beyond that gets invested. Nothing fancy, just simple, consistent investing. Now fast forward 5 years, the first person still sees a big number in their bank, $70,000. Looks solid, feels safe. The second person, less cash in the bank, but a higher total net worth, more growth, more momentum. And here's the strange part. The person with less cash is actually in a stronger financial position. This isn't about taking big risks. It's about understanding what cash can do and what it can't. Cash protects you from problems you can see, but it slowly creates problems you don't. Because while your money sits still, everything else keeps moving. Prices rise, opportunities pass, and quietly, your money starts falling behind. Hi, I'm Rishi, and for a long time, I thought saving more cash was always the right move. More savings meant more safety, more control, less stress. But the more I started paying attention, the more I noticed something different. People who only saved stayed in the same place, while people who invested, even a little, started pulling ahead. Not overnight, not dramatically, but consistently. So in this video, I want to break down why keeping too much cash in the bank can actually work against you and how to think about your money in a smarter way. Let's get into it. Let's start with something simple. Why does cash feel so good? Because it's predictable. No fluctuations, no uncertainty. You open your banking app and the number is exactly what you expect. That stability feels like progress. But here's the problem. Stability is not the same as growth. There's something happening in the background, whether you notice it or not. Inflation. You've already felt it. Groceries getting more expensive, rent creeping up, everyday costs slowly rising. Now imagine you have $50,000 sitting in your bank account. It stays $50,000 next year and the year after that. But what that money can buy keeps shrinking. Even at a modest 3% inflation rate, you're losing value every single year. No bad decisions, no spending mistakes, just time. This is where most people get stuck. They think, I'm not losing money, I'm saving it. But in reality, they're losing purchasing power, and over long periods, that adds up in a big way. Now, let's go back to those two people, the saver and the investor. The saver avoids risk completely, keeps building cash, feels secure. The investor does something slightly uncomfortable, keeps a safety net, and puts the rest to work. And this is where things start to separate, because money that's invested has the ability to grow. Not perfectly, not every year, but over time. Historically, markets have delivered positive returns over long periods. Not in a straight line. There are drops, corrections, uncertainty, but zoom out and the trend is clear. Growth. So while one person's money stays flat, the other person's money starts compounding, earning returns on top of previous returns. That's where the real difference comes from. Let me make this even more real. Imagine two timelines. In the first one, you keep an extra $25,000 in cash for the next 10 years. It stays safe, stable, always there. In the second timeline, that same $25,000 is invested and grows at an average of 7 to 8% per year. After 10 years, that money could be close to $50,000. Same starting point, same person, different outcome. And the difference didn't come from working harder or earning more. It came from one decision, letting money work instead of just holding it. This is where most people underestimate time, because nothing feels different in the first year, or even the second. But by year 5, year 10, the gap becomes obvious, not because of big moves, but because of consistent direction. There's actually a pattern you start noticing. Some people are very disciplined savers, but never move past that stage. They build cash, but don't build wealth. Meanwhile, others focus less on the size of their bank balance and more on where their money is going. And over time, that difference becomes obvious, not immediately, but gradually. Let's talk about something most people ignore, opportunity cost. It's not what you lose directly, it's what you miss out on. If you keep an extra $30,000 in cash for years, that money isn't just safe, it's inactive. It's not growing, not compounding, not doing anything. And the longer it stays that way, the bigger the gap becomes between where you are and where you could have been. Now, to be clear, this isn't about avoiding cash completely. Cash has a job, a very important one. It gives you stability, flexibility, protection when things go wrong, unexpected expenses, job loss, emergencies. That's why having an emergency fund matters. But beyond that, cash starts becoming inefficient.
Think of it like this. Cash is your defense. Investing is your offense. There's also something else that happens when you rely too much on cash. You start thinking short term. Every decision becomes about safety, avoiding loss, staying comfortable. And while that sounds smart, it limits how far you can go because long-term progress requires a different mindset. Not reckless risk, but calculated growth, the kind where you accept small ups and downs in exchange for bigger outcomes later. People who build real wealth don't avoid movement. They manage it. They understand that temporary drops are part of long-term gains, and that staying completely still has its own cost. It just doesn't feel as obvious. If you only play defense, you don't lose quickly, but you don't win either. And over time, that becomes a problem. If you're still watching, you're probably not just trying to save money. You're trying to understand how to actually grow it. And if that's the case, you can subscribe. No pressure, just more conversations like this. Let's address the biggest concern. What if the market crashes? Because that's the reason most people hold too much cash. And it's a fair concern. Markets do go down, sometimes sharply. But here's what matters: time. Short-term movements are unpredictable. Long-term trends are much more stable. People who invest consistently over time and don't panic during downturns usually come out ahead, not because they timed it perfectly, but because they stayed in the game. Another hidden issue with too much cash is comfort. A large bank balance feels like progress, so you stop questioning it, stop optimizing, stop learning, because everything feels fine. But that comfort can quietly slow you down, because your money isn't improving your situation, it's just sitting there. Now, let's make this practical. What should you actually do? Start with a clear safety net. 3 to 6 months of essential expenses. That's your foundation. That's your protection. After that, your extra money should have a purpose, and that purpose is growth. You don't need complex strategies. You don't need to chase trends. Just simple, consistent investing over time. That's enough. Even small shifts matter. You don't need to move everything at once. Just start. Because once your money starts working, it changes the entire system. It's no longer just about how much you earn. It's also about how your money performs. Here's the bigger picture. Money has 2 roles: to protect you today and to build your future. Cash does the first one well, but struggles with the second. And if you rely only on cash, you're solving half the problem. One more thing worth thinking about: liquidity versus growth. Cash is liquid. You can access it instantly. That's valuable. But growth assets, like investments, trade a bit of that instant access for long-term returns. And the goal isn't to choose one over the other. It's to balance both. Enough liquidity to handle life and enough growth to improve it. Because if all your money is liquid, you stay flexible, but don't move forward. And if all your money is invested, you grow, but lose flexibility. The real strategy sits somewhere in between. The goal isn't to have the biggest bank balance, it's to have the strongest financial position. And those two things are not the same. One looks safe, the other actually is. So the next time you check your bank account and feel good about a large number sitting there, take a second and ask, is this money helping me move forward or just staying where it is? Because that one question can completely change how you manage your money. And over time, that change can make all the difference. The difference between people who stay stuck and people who move ahead isn't just how much they save, it's what they do after saving. And once you understand that, you stop thinking of cash as the final goal and start seeing it as the starting point.